In the world of investing, there's a fundamental principle that reigns supreme. Time in the market beats timing the market. This principle emphasizes that staying invested for the long haul is more crucial than trying to predict short-term market fluctuations. It's a concept deeply intertwined with the age-old debate of lump sum investing versus dollar-cost averaging. Lump sum investing advocates for investing your entire capital up front. This strategy aligns perfectly with the time in the market philosophy. By investing immediately, you maximize the duration your money spends growing in the market. Conversely, dollar-cost averaging involves investing fixed amounts at regular intervals, regardless of market conditions. While dollar-cost averaging offers a sense of control and risk mitigation, it inherently reduces the time your money spends exposed to potential market growth. This fundamental difference in market exposure forms the crux of the lump sum versus dollar-cost averaging debate. Understanding this core principle is paramount as we delve deeper into the nuances of these two investment approaches. One of the most powerful forces in finance, compounding, is often referred to as the eighth wonder of the world. It's the snowball effect of earning returns on your initial investment and then earning returns on those returns, leading to exponential growth over time. Lump sum investing harnesses the full potential of compounding. When you invest a lump sum, your entire capital starts working for you immediately. Every subsequent market gain is calculated on a larger base, leading to a snowball effect that accelerates your wealth accumulation. On the other hand, dollar-cost averaging's staggered investment approach limits the power of compounding, at least initially. Since you're gradually deploying your capital, a smaller portion benefits from the magic of compounding in the early stages. While dollar-cost averaging eventually exposes your entire capital to the market, it misses out on the initial compounding boost that lump sum investing enjoys. To illustrate, consider investing $10,000 with an annual return of 7%. After 10 years, a lump sum investment would grow to approximately $19,671, while dollar-cost averaging might only reach around $17,000. This difference highlights the potential opportunity cost of delaying investment through dollar-cost averaging, especially in a consistently growing market. While the mathematics of compounding might favor lump sum investing, the emotional aspect of investing cannot be disregarded. This is where dollar-cost averaging shines as a valuable tool for managing psychological biases and promoting investor discipline. Market volatility is an inherent part of investing. Even seasoned investors can be swayed by fear and greed during periods of market turbulence. Dollar-cost averaging provides a psychological buffer by averaging out the purchase price of your investments over time. This strategy can be particularly beneficial for new investors who might feel overwhelmed by the prospect of investing a large sum of money all at once. Dollar-cost averaging allows them to dip their toes into the market gradually, building confidence and discipline along the way. Moreover, dollar-cost averaging can help mitigate the risk of investing a lump sum right before a market downturn. While timing the market is notoriously difficult, dollar-cost averaging's gradual approach reduces the impact of short-term market fluctuations on your overall portfolio. The effectiveness of lump sum investing versus dollar-cost averaging is significantly influenced by market trends and your investment time horizon. Historically, over long periods, the stock market tends to trend upwards. In such upward trending markets, lump sum investing often outperforms dollar-cost averaging by maximizing the time your money spends exposed to potential growth. However, in volatile or sideways markets, where prices fluctuate without a clear upward trend, dollar-cost averaging might offer a slight advantage. By averaging your purchase price over time, you reduce the risk of buying at a market peak. Your investment time horizon also plays a crucial role. For long-term goals, such as retirement planning, where your investment horizon spans decades, the historical upward trend of the market favors lump sum investing. The power of compounding over such extended periods often outweighs any potential short-term market fluctuations. Conversely, for shorter-term goals with a time horizon of fewer than 5 years, dollar-cost averaging might be a more suitable approach. The market's behavior in such a short time frame is less predictable, and dollar-cost averaging's averaging effect can help mitigate potential losses. Section 5. The Opportunity Cost of Waiting, DCA's Potential Downside. While dollar-cost averaging offers a sense of control and emotional comfort, It's important to acknowledge the opportunity cost associated with this strategy. By gradually investing your capital, you're essentially holding a portion of it in cash, potentially missing out on market gains. In upward trending markets, the longer you keep your money on the sidelines, the higher the opportunity cost. This cost is amplified by the fact that historically, the stock market has generated higher returns than cash or cash equivalents like savings accounts. Moreover, inflation erodes the purchasing power of money over time. By keeping a significant portion of your capital in cash while employing dollar-cost averaging, you're essentially losing purchasing power due to inflation's impact. While dollar-cost averaging's averaging effect can be beneficial in declining markets, it's crucial to remember that market downturns are typically shorter-lived than bull markets. Therefore, the potential gains from being fully invested during bull markets often outweigh the losses mitigated by dollar-cost averaging during market dips. Section 6. Hybrid Strategies, Bridging the Gap. For investors seeking a balance between the potential benefits of lump sum investing and the emotional comfort of dollar-cost averaging, hybrid strategies offer a viable solution. One common hybrid approach involves investing a significant portion of your capital as a lump sum up front, while dollar-cost averaging the remaining amount over a predetermined period. This strategy allows you to benefit from the immediate market exposure of a lump sum while mitigating some of the emotional risks associated with investing a large sum all at once. Another hybrid strategy involves adjusting your dollar-cost averaging contributions based on market conditions. For example, you could increase your contributions during market dips and decrease them during periods of market exuberance. Hybrid strategies offer a flexible and customizable approach to investing, allowing you to tailor your strategy based on your individual risk tolerance, financial goals, and market outlook. Section 7. Value Averaging, a Dynamic Approach. Value averaging is another investment strategy that shares similarities with dollar-cost averaging, but with a more dynamic approach. Instead of investing fixed amounts at regular intervals, value averaging involves adjusting your contributions based on the performance of your portfolio. With value averaging, you set a target portfolio value for each period. If your portfolio value is below the target, you invest more money to bring it up to the target level. Conversely, if your portfolio value exceeds the target, you sell a portion of your holdings to bring it back in line. This dynamic approach aims to capitalize on market fluctuations by buying more when prices are low and selling when prices are high. However, value averaging requires more active management and monitoring compared to dollar-cost averaging, and it might not be suitable for all investors. Section 8. Tailoring your strategy, finding the right fit. The decision of whether to choose lump sum investing, dollar-cost averaging, or a hybrid approach ultimately depends on your individual circumstances, risk tolerance, and financial goals. If you have a long-term investment horizon, a high risk tolerance, and you're comfortable with potential market volatility, lump sum investing might be the most suitable approach. Historically, it has shown the potential for higher returns over the long run by maximizing time in the market and harnessing the power of compounding. On the other hand, if you're risk-averse, new to investing, or have a shorter-term investment horizon, dollar-cost averaging can provide a sense of control and emotional comfort. It's a disciplined approach that mitigates the impact of market fluctuations and allows you to gradually build your investment portfolio. For investors seeking a balance between these two approaches, hybrid strategies offer a flexible and customizable solution. By combining elements of both lump sum investing and dollar-cost averaging, you can tailor your strategy to align with your individual risk tolerance and financial goals. Section 9. Conclusion: Embracing the long-term perspective. Regardless of the investment strategy you choose, it's crucial to approach investing with a long-term perspective. Market fluctuations are inevitable, but over the long run, the stock market has historically trended upwards. Remember that time in the market is your greatest ally. Whether you choose to invest a lump sum, dollar-cost average, or employ a hybrid approach, the key is to stay invested, remain disciplined, and ride out the inevitable market ups and downs. Regularly review your investment strategy and make adjustments as needed based on your evolving financial goals, risk tolerance, and market conditions. Investing is not a one-size-fits-all endeavor, and finding the right approach for you is an ongoing journey.